Hello and good evening, and I'm David Gill, Head of Product Management at Self-Trade, and welcome to the second in our series of 3 webinars with Francis Moore, Managing Director of EPML. I have to say we have a rather dapper looking Francis with us tonight, but a little bit more of that in a moment. Welcome back to those of you who joined us for the first webinar last week, and to those who are fresh, I'll run through in a moment just the details of how to use the screen in front of you. But to say, if you did miss last week, not to worry, a recording of that is now available on the Self-Trade website. So do take a chance to go and have a look at that if you'd like to do so. So to our newcomers, welcome, and a quick run through of how to use the platform. So beneath the video screen, you'll see a box where you can type in questions. Simply type a question into there, press submit, and our moderators at this end will capture it and display it on the screen above Francis's biography. If you do see a box asking for your email address, if you would fill that in, please, that enables us to get back to you to check that you've got an answer that you want. But worry not, we certainly won't be inundating you with emails after the event. So that's the basic details. Underneath that, you'll also see a box for feedback, and we would very much appreciate if you take a few moments at the end of the webinar this evening just to let us know your thoughts, good and bad, so that we can take those into account for future events. So that's how to use the platform. Hopefully that'll be nice and simple for you. So let me just introduce a rather dapper Francis Moore. So Francis, it looks like you're off to a bit of a do tonight. Do tell.
Yes, indeed. We've been nominated for Best SIPP Provider of the Year as part of the Shares Magazine Awards at the Grosvenor Hotel tonight.
Excellent.
So I shall be on the way to the awards dinner after we've completed our webinar.
Good. Well, we'll try and get you off on time, Francis, and best of luck with those. I have to say that we too are joining you on the roster of nominees, so we hope that both of us will walk away successfully tonight, albeit that I won't be there to witness it. So do have a good time. So, ladies and gentlemen, if you're sitting comfortably, a cup of tea to hand, let me hand over for this session to Francis. Francis is going to be looking at taxation issues, investing in your SIPP, and some of the administration things that need to be done throughout the time you're running a SIPP. So, without any further ado, over to Francis, and I'll join you again later for the question and answer session in about half an hour's time. Francis.
Thanks very much, Dave. I'm going to start, as I did last week, with just a quick health warning, which is that SIPPs aren't suitable for everybody. So please make sure that you do your research and check whether a stakeholder pension or a personal pension could be more suitable for you, rather than diving into a SIPP, which is quite complex. It's a powerful instrument, and you really do need to check it out to make sure that it's going to deliver the right scope for you. Tonight I'm going to start with contributions and tax relief. Starting with employer contributions, those are actually paid gross to the SIPP, so there's no real impact on you, the member. Where it starts to get a little bit more complex is where you as a member are making a contribution, a personal contribution, and effectively the rules are that you pay net of basic rate tax at 20%. So effectively for a £1,000 contribution you'll be paying us £800, and then we collect the basic rate tax relief of £200 from HMRC. Now this does mean that in effect for cash flow purposes you're paying us £800, and then there's a small delay of between about 5 and 11 weeks depending on the actual timing. Now you can be quite cute with the timing because essentially the claims that we do are from the 6th of the previous month to the 5th of the current month. So if I put that into the context of this month, November, if you paid contributions from the 6th of October through to the 5th of November, then we put those into the tax claim that goes in for November to HMRC, and then HMRC will remit those tax relief to us by the end of December. So clearly if you can time your contributions towards the end of the month, or at least between perhaps the 1st and the 5th, then that's the most advantageous point for getting tax relief as quickly as possible. You need to be careful, particularly with regular contributions, that you don't skip over from a 5th to, say, a 6th, because that will take you into a next month. And at the end of a financial year, you need to be careful. And indeed, this year we had quite a complex situation because the last working day was actually Maundy Thursday because of Easter and the bank holiday on the 5th of April. So it is something that you need to look out for at the end of the year just to make sure the timing of your contributions. Now, if you're paying by cheque, it's in fact the date of receipt that we receive the cheque that counts. So actually this year it would have been quite a good move if you wanted to make a late payment to have done that by cheque over the weekend, and that would have been perfectly acceptable at the end of or before the 5th of April. So it is important that you check the types of payment, and on that, faster payments, which seem to be a good idea, can actually count against you. And indeed, we found that if anyone had made a payment by faster payment this year after the Maundy Thursday, it would actually have come through on the bank on the 6th of April, i.e. going into the next tax year. For those of you with higher rate tax relief, then effectively what you're going to do is you're going to put the contributions that you make onto your self-assessment form, and the Inspector of Taxes will then grant you the additional marginal relief against you personally. So it's not true to say that if you were this year, say, a 50% taxpayer, that you would get 50% tax relief going into the SIPP. It's the basic rate that goes in, and then the marginal relief is actually given to you personally. And that's a common misconception that we find. There is a more complex area called pension input periods, which I'm not going to tackle as part of this presentation, but essentially that can enable people to maximise contributions by effectively spreading them across 2 tax years. But that is a more complex area and worthy of one for those of you with larger contributions that you want to try and spread. The other aspect that's coming up is that we're going to move away on contributions from the very complex legacy that the outgoing government gave us. And from 2011, we're going to be moving towards a cap of 50,000 on contributions, but with the opportunity for carry forward. Now, with the legislation yet to be framed for all of that, I think I'll just leave it as that summary for now, but there will be the opportunity to top up for those people who don't make full use of their £50,000 allowance. But may I remind you that, of course, in order to make the contributions, you do need the earnings. So if you're making a £50,000 contribution, you must have at least £50,000 worth of earnings. And that is something, as we said in the last seminar, that we actually check up on with you to make sure there are no accidents there. Just moving on, the other means of generally funding your SIPP is going to be through transfers, and again I covered that in the first seminar. But just to remind you that because you're likely to be sweeping up transfers from all sorts of sources, including perhaps a forgotten protected rights policy that you may have taken out to contract out of the state earnings related pension scheme, and typically those have been insurance policies, not particularly good performance and possibly higher charges. And with protected rights now accepted into SIPPs from October 2008, that can be quite a good move to bring a protected rights across. How to do that? Well, contact the life company or the seeding pension scheme administrator, ask them to provide a transfer discharge form, and that will then come through to you. There'll be a section which you complete as the member, and then a much larger section that we have to complete as the receiving scheme. So you'll send all that through to us. We will then complete the additional paperwork and send it on to the seeding scheme. And as I said last week, the timescales for payment really do vary. And so again, that's well worth checking out with the seeding scheme as to how long they think they will take to actually process, because effectively you're going to be out of the market for that period. So that covers off contributions and transfers. Now moving on to, well, what happens to the money? Well, as part of the establishment of the SIPP for you, we set up a scheme bank account. And effectively that becomes the audit trail for all contributions and transfers, and indeed tax relief that is applied to the account. The signatories for SIPP bank accounts will vary according to the type of scheme, and again I outlined the different types of scheme last week. In our case, we're a master trust, so it is actually our company that actually is the signatory to the accounts, but these days we tend to move money electronically. But the key thing here is that we're doing it to member direction, so we're actually ensuring that you, the member, provide us with the authority to move money for an investment or to a stockbroker. And that's very key. Interest. Well, interest is applied. There's not a huge amount of it at the moment in the scheme bank accounts and the SIPP bank account, but it is paid gross. There's nothing for you to need to do in terms of declaring that on any tax forms, and effectively when it's applied, then obviously it becomes available for you to invest. While I'm talking about the SIPP bank account, with the rates not particularly high, we've been one of the few firms that's actually offered external bank accounts, and that enables you to go out for term deposits, even call accounts, offering higher rates. But again, with all these types of accounts, you need to look at how long that you're going to be perhaps potentially locked in, and whether you can get funds out if you suddenly decide that you want to go back into the market. So these are all considerations that you need to look at. There are not a huge amount of external bank accounts, mainly because we're establishing them as a trustee, and all those exciting offers that you see on the internet promising you very high rates of interest are really designed for personal account holders, because what they're really trying to do is to get hold of your personal information and cross-sell you lots of other products. We're rather boring as a trustee, so the rates for us are not typically that great, but certainly better than the SIPP trust account itself. However, the whole purpose of SIPPs, of course, is to try and invest in a very broad range of investments. So it's unlikely, unless you're looking at cash diversification for any reason, that you're going to be holding huge amounts in your SIPP trust account. But do bear that in mind. There can be moments where you would like to do that. But typically, you're going to want the money to move as quickly as possible across perhaps to a self-trade SIPP dealing account, for instance, so that you can trade. In terms of investments, one thing again I should say is that it's part of the health warning. You are taking responsibility for the investment of your pension scheme, probably one of the largest assets that actually you're going to have as a holding. So it's important that you view pension scheme investment as investment, not speculation. And you really need to ask yourself, are you genuinely up to the job of managing or taking the risks in investing your pension future? There are options. For instance, you may want to consider whether you do it yourself. You may want to consider whether you ask an advisor to help you on an advisory basis, so where they nominate the investments to your particular needs, but you have the final decision. And then thirdly, there's discretionary fund management, where you actually outsource the investment management to a third party who operates it according to your risk profile and mandate. So there are a number of options, and indeed you can actually run all of them simultaneously in a SIPP. So that is actually quite a positive aspect of the power of SIPPs. One other issue is that since pension simplification, we've moved away from a sort of prescribed list of what the Inland Revenue will permit towards a situation where almost anything is permitted, but taxable property, and that's something I'm going to come back to in a moment, will apply. So something may be very exciting. And indeed, the Shares Award tonight, the editor of Shares, Russ Mould, who's been on a number of the Sippexes, etc., always teases me in presentations because he likes to wind me up about the possibility of SIPPs investing in wine and residential property, vintage cars, racehorses and yachts. And interestingly, yachts are probably one of the most common questions that we get, because people have an idea that by turning them into a commercial venture, such as yacht charter, that somehow they will become a qualifying investment. The sad news is, no, they won't. It'll be taxable property, and you could end up with a very large tax bill for trying to go that route. The other sort of broad investment challenge these days is whether you go with, for instance, active fund managers, or whether you choose to go the passive route, or perhaps a mixture of the two. And that's something on which there's more and more research coming through, and there are far more eloquent people on the subject, on that subject, than I. But the essential difference is that active funds are there to try and outperform an index, but they can be expensive. Trackers are linked to an index, but are relatively cheap. So you take your choice at the end of the day. So what are sort of permitted investments? Well, listed equities from around the world. I think Self-Trade have something like 19 markets on their platform, for instance. Bonds, gilts, corporate bonds. There's a very wide range. And then coming through into funds, you've got things like unit trusts, you've got CCAVs, UCITS, and investment trusts, for instance. There's a very wide range of funds that you can invest in and through a SIPP. And really, the scope is almost too wide to run through in this particular presentation. Moving on, we've got things like commercial property that's driven the SIPP market in some sectors quite heavily. The issues that we come to are, what do we need to be concerned about in terms of when we're establishing a stockbroking account, like, for instance, the Self-Trade account, or for another stockbroker, or for a wrap platform? There are a myriad of ways in which you can invest these days. Well, one of the things that we need to do from the administration side is to make sure that the account is appropriately ring-fenced. And that is to say that we, as the owner of the account, expect that money will only flow from ourselves or be returned to ourselves, and that it can't leak out of the account and drop into your ISA or into a dealing account by accident. It's very important that funds stay within the SIPP and to our order. When we're doing things like in specie transfers, then again we will instruct the brokers as to precisely what they should expect or to send away to another broker in the case of a transfer out. These are important because if you have a situation of an unauthorised withdrawal, then the tax consequences are extremely severe. In terms of the account, one of the things that we're doing as trustee is we're actually delegating to you the responsibility, or indeed we may delegate to an IFA at your request, the dealing on the account. Now, in the case of execution brokers, they may not have that facility to be able to accept an IFA taking investment decisions to your order and then booking them. That typically takes place on wrap platforms. However, the key thing is that you're in control. So effectively, we will move, once we've established the account, we will move the money to your order across to the broking account, and there you have cleared funds against which you can then deal to suit your timing, and you may be able to do that via the internet, or you may be able to do that by telephone. And indeed, there will be some that still accept paper, but those are becoming fewer and far between. In return, we expect the broker, or more and more, we're expecting brokers to provide us with the detail of your trades to come across in terms of a data feed. Why? Because as trustee, we need to track what is actually going on your account and to make sure that in cases where perhaps an investment is undertaken, that shouldn't be, that we can actually track that. Now, obviously, the cost of tracking trades and corporate actions by hand is very costly. So the more we can get a feed. Now, we will pass on costs, but I'm pleased to say that with brokers like Self-Trade, we have a data feed, and therefore we don't have to pass on booking costs. But that's not the same for every provider, and that's not the same for every broker or wrap platform or investment manager that you may be dealing with. In terms of dividends, etc., because the assets are held within, and for instance in the Self-Trade case, within their nominee, then dividends are paid out into the account. There was the change that Gordon Brown introduced way back in 1997 when the taxation situation for companies and dividends was changed. So we're unable now to reclaim the 10% deduction on dividends. But where there's income deductions on income, although we try and ask our investment counterparties to get things like PIBs paid gross, that doesn't always happen. So there will be situations where we have to do tax reclaims. And I can sort of touch on that at the moment, in that the broker will provide us at the end of the year with a consolidated tax voucher. Now, if you get one of those, it's a copy. You don't actually have to do anything with it. We deal with the consolidated tax voucher and then make the claim. The Inland Revenue have changed the way in which claims have to be admitted now, which is slightly tougher, particularly where we're dealing with more than one investment manager and broker, because we're dependent really on how quickly the slowest of those can deliver us the tax information. But once we can process that claim, then we will pop the income tax reclaimed into your SIPP designated account, and then you're free to pass that across to your chosen investment area. SIPPs can support multiple investment accounts, as I said earlier. Other areas of investment that have been popular recently, and you've probably been watching the gold price accelerating as worries around the world turn people to gold. But gold bullion is actually a permitted investment, provided it's of investment grade. So that is the distinction. But for instance, silver and other commodities, unless they're within the form of a fund or an exchange-traded commodity, are not permitted. The big area that people like to look at is commercial property, and really that commercial property needs a little bit of a health warning, to the extent that sometimes people think that small properties will only have small expenses, and that actually is not the case. We need lawyers to check out title, there's environmental checks that need to be carried out, so there's actually a significant amount of base cost in any commercial property transaction to cover all the due diligence, etc. One of the attractions of commercial property, though, has been the ability to borrow against the property, and the HMRC have a limit of 50% of the fund, the SIPP fund, that you may borrow at any one time. However, where a property perhaps has been opted to tax, that's VAT, then although we can reclaim the VAT on a property purchase, you can't borrow the extra. So any VAT has to be taken into consideration within the 50% maximum borrowing limit. And indeed, you also need to take into account any other expenses such as stamp duty and of course those legal and surveyor's charges. We can, in property, take on properties through what's called a transfer of going concern, but as ever with that, it's a very complex area, and as a firm we have a policy that we put any VAT situations out to a VAT consulting firm to make sure that everything's going okay. In terms of buying property, yes, transactions can be done with connected parties, but they have to be on an open market valuation basis, and that can be quite important, and it's not worth trying to skimp that because at the end of the day, if HMRC argue with the value, then you could find that again there's a taxable charge that comes through. It's also possible to do pooled property transactions where more than one person can actually be involved in purchasing, so suitable for perhaps partners of legal firms or accountants or other partnerships, or indeed even within a corporate structure. Residential property was, of course, very much hyped ahead of the simplification back in 2005, 2006. And often people think residential property is banned. Well, no, but the way the last government approached it was not to ban things, but to tax them out of existence. So provided residential property meets what's called the genuinely diverse vehicle criteria, which is a fund of at least £1 million, 3 or more properties of which no one may be more than 40%, and of course no connected transactions with any of the members, then residential property can work. But again, perhaps some specialist advice would be advisable around that area because of issues about how you actually land bank the properties to commence the fund, etc. Things can go wrong, and obviously sometimes where the property is let back to an employer or let back to your firm, perhaps you actually get into some financial difficulty. And I'm afraid here the revenue are not hugely sympathetic and are not going to let you have a huge rent holiday just because you have some financial issues. In fact, they will, at a point, expect any missed payments to be reported as an unauthorised payment, again with significant tax issues around that. So whenever the SIPP is not, just there to ameliorate situations, it has to be seen as operating on its own and quite independently of your other considerations. In terms of in terms of investments with connected parties, as I mentioned, independent valuations are absolutely key. And sometimes, particularly for unquoted investments, they can be very difficult to get hold of. So that's an area where some care needs to be taken because it can really add to costs. The other area that we grimace really whenever we get someone come forward is in the area of, I want to invest in my friend's company. Well, that might be possible, but you can't do it on friendly terms. You've got to make sure that all the checks and balances, such as maybe having key man insurance on your friend who's running an investment management company, making sure there's a proper shareholders agreement so that your interests as a minority shareholder through us, the SIPP, are actually protected. So private equity can be a very interesting area. Unquoted funds can be an interesting area. But as a trustee, we need to drill through and certainly in terms of funds, make sure there's going to be no taxable property considerations because, as I said, the damage there can be significant. The other part of it, of course, is the more complex the investment, then it's likely the higher the costs are going to be. And I think, again, where people are moving from listed securities and having that convenience of being able to deal very easily on the stock market, somehow there's a sort of a feeling, well, okay, we can do that with private equity. Well, the answer is you can't. It's not as simple as just buying and selling a listed share. There's a lot of due diligence that needs to be done. And these transactions can't be done in a few seconds. They may even take weeks or months to conclude. Now, moving on in terms of administration, probably the key thing that needs to come through, whatever your investments are, is the provision each year of an annual statement and statutory money purchase illustration. And that the idea of the SMPI illustration is to set out what your pension is worth in today's terms. And over the last few years, sometimes that's made very grim reading, but it underlines the need and the importance for starting out in terms of pension provision as early as possible. I'll touch just very briefly that if you have an IFA, then we're going to have extra work to do in terms of communicating with your IFA, in terms of actually authenticating the IFA, maybe paying commission or fees to him, dealing with the advice issues that are coming through from him. And it may be that he will want to become involved, having given you advice about investments and actually placing it on a platform. And we need to make sure that the appropriate delegations are in place and that those are audited from time to time. Alternatively, you may have an IFA who increasingly may now also have the powers to be a discretionary investment manager. So again, we would be treating him in two halves, one as your advisor and secondly as an investment manager. In terms of other administration, I'm going to have to skate on now. We obviously are looking after, how to communicate with you. So we'll be dealing with changes of address, changes of telephone numbers, email these days. Nominated beneficiaries. I'll come back to nominated beneficiaries more in the next webinar. But it's important that you keep us up to date with whom you're nominating to receive benefits should you unfortunately fall under the bus, as it were. You also may wish to change your selected retirement age, and with the changes that again we're going to be talking about next week, we're going to see situations where the retirement zone is changing. So currently 55 through to 75/77 for technical reasons, but you have the flexibility to change. You may wish to change your contributions. Typically those come through by standing order, so we need to make sure those come through a new standing order, or they may come through some providers by direct debit. You may want to change or add to your investment managers. And indeed, there may be situations where we need to handle powers of attorney, and indeed we have many happy parents and grandparents looking after the investments for their SIPPs for Kids arrangements, of which there is a growing demand. So I've skated through the sort of administration, but I hope it starts to give you a flavour that SIPPs are very, very wide in terms of the potential of what they can do. As always, I'll give a health warning that the more complex that you the investments that you're trying to do, then it is more likely that your SIPP is going to cost you more money. But there's a great variety of SIPPs out in the market, and certainly the arrangements that we have between ourselves and Self-Trade, for instance, give you the ability to deal in a very wide range of investments very simply and very cost effectively. But if you move off those platforms and into the more esoteric investments, then you really do have to expect that it will cost you a lot more. So I'm going to end the session there, Dave, and over to you.
Well, thank you, Francis. I think you've given us a very good overview of the sorts of things that can go on in the SIPP and some of the things that you need to think about in deciding whether those are the things that are going to go on in your SIPP. Francis mentioned the wide range of investments you can make, and if you'd like a bit more information about that, then could I point you to Jonathan Ely's session at our recent Sippex seminar, footage of which is available on the Self-Trade website. Jonathan's the editor of Investors Chronicle, and he takes you through some of the basic tenets and probably reminds many of us of the things that you really should be thinking about when you are going to make those investment decisions. So I'd encourage you to take a look at that and just pick up some of those pointers from Jonathan. Now, Francis, we have had a few questions coming in as you've been talking, a couple of which, in fact, I think you've probably preempted and covered. So let's go to Barry's question first. And Barry's asked something which is very topical, and that is about the issue of getting good interest rates on cash. Now, I think last time I remember you mentioning that, of course, cash isn't just about bank accounts. You can buy money market funds, for instance, and that's an opportunity. But Barry's looking for information about where he can find a list of banks that can give him access to term deposits within the SIPP. Can you help with that?
Yes, certainly we have a number of bank account links that very often, in fact, are actually generated by clients coming to us and saying, can we invest in XYZ bank? And we'll investigate that, and essentially we need to go through the same ring fencing. we may need to make sure that money is held to our account and that the account is actually suitable for a corporate trustee on behalf of the SIPP member to make that investment. And that's the big area that people come to us with a very exciting offer that they found on the internet, and actually it's aimed for individuals, not for corporate trustees. But certainly we ourselves, when we were in the banking crisis, we had quite a number of clients that were obviously very concerned. And one of the big considerations is effectively the Financial Services Compensation Scheme through the Bank Deposit Scheme, which has been changed and is now up to $50,000 per account. And certainly we had a few customers where we were opening up quite a number of accounts. Again, there's costs associated with that, because the more accounts there are, then the more we have to do, and I'm afraid the more we have to pass on in terms of charges. But that flexibility is there, and we would certainly be very happy to help anybody with that. One of the banks that we had quite an amount invested in was actually Anglo-Irish in Ireland. And as we know, there have been significant issues with the Irish government needing to bail out their banking sector. Just indeed, there was a bailout of our own sector. And so there's been some quite interesting situations where the rates are quite high, but of course the risks are much higher. And it's been interesting, with clients going through and looking at that risk assessment, and obviously becoming in some cases a bit more concerned, because the risk moved away from just the individual bank, but actually became one of a sovereign issue.
Indeed.
And that's been quite a challenge, and so we've actually seen money flowing in and out of a bank in that situation where, yes, the rates are higher, but the risks are higher, and people wanting to close out positions or to get back in and to make use of that opportunity.
Okay, so would it be fair to say then, in response to the couple of questions we've had about finding this, it's more a case of finding a deposit that you're interested in and going to talk to your SIPP trustee to say, can you arrange for some of my SIPP money to be held in this account?
I would actually turn that slightly on its head, Dave. I think it's actually worth going to talk to your SIPP operator and just see what links they've actually got in place. Now, some may have a policy, and indeed some have a policy of only having the SIPP trust account and not allowing any external. In our case, we've always had a more liberal approach to it, so well worth coming and talking. But equally, if someone comes across an interesting bank deposit opportunity, but we do need to look, and what we will always try and do is look into the background, because often, if you get a higher rate, you're not getting it for free. There's usually risk in there. And one of the key things is looking at, bank deposit guarantees. And interestingly, again, perhaps a sort of legacy of the past, people looking to offshore because of gross paying accounts. Well, we get interest gross, or we would expect it to be paid gross anyway. But for instance, in the Channel Islands, you could be doing, a very nice bank deposit, but there's no protection for you. Isle of Man, we saw some grief in the Isle of Man because the SIPP protection was not nearly as extensive as indeed the work or the protection afforded by the FSCS in the UK. And a lot of that came down to the definition of, who the beneficiary was. Yes. So these are very important minutiae, which people tend to overlook when they're looking just at the headline rate, because that's exciting, but actually could make the difference between retaining your deposit or actually losing a good chunk of it.
Good, thank you. And just to add to Francis' comments about the Financial Service Compensation Scheme, the scheme limit does go up. There's, the FSA are currently consulting how they're going to deal with the new European €100,000 limit. So do keep an eye on the Financial Service Compensation Scheme website for details about that. So hopefully that's answered that particular point. Thank you for that, Francis. Gary's asked about transferring funds from an existing pension and whether he can do that in specie or whether he has to sell them. Now, Gary, we did cover that to a degree last week, so Francis, perhaps you could just very briefly give us a quick resume of that, and we could point Gary back to the recording of last week's seminar for a bit further detail.
Yep, no, Dave, absolutely, it's possible. But what you need to be, well, what we all collectively need to make sure is that, of course, the investments that you're trying to transfer to, say, self-trade, and the self-trade nominee, can actually be held in the nominee. Now, if they're CREST eligible securities, there's not likely to be any real problem. But if you had an asset, and the issues that we have are people will, perhaps see an insurance company fund and think possibly that could be transferred in specie, and the likelihood is it can't be and would actually have to be encashed. So again, whenever you're thinking of trying to transfer in specie, you need to be talking to your scheme trustee. You need to be also who needs to be involving the receiving scheme broker, just to make sure that the asset list, in terms of what is currently held, can either in total or in part be transferred in specie. But it's certainly possible, much easier, broker to broker or wrap platform to wrap platform or whatever. More difficult when it comes to things like commercial property, because actually there it's not a simple in specie transfer, because actually we're going to have to change the title. We're going to have to become the owner. So there will be quite significant legal costs there. So it really does depend on the type of asset, but listed stocks and shares, unit trusts, OICs, etc., are going to be generally, fairly easy to transfer on an in-specie basis.
Thank you. And that, I think, is fair to say, goes for AIM shares as well, albeit, as Rachel's commented in one of her questions, that she can't hold those in an ISA, but I believe you can now in a
Yes,
SIPP.
you can. And indeed, we've been able to get into the plus market as well. And sort of an associated part of that is that we've even seen people actually transferring in VCTs. Once they've taken advantage of the tax advantages and those have expired, then actually bringing those in. But again, very important to remember that you can't just transfer things, and as we covered last week, into a SIPP. We either have to buy them, so you need the cash there, or it needs to be an in-specie contribution with the complexities I touched on last week.
Good, thank you. Now, Greg's asked about what he needs to put on his self-assessment return, and Peter's asked a sort of related question about the consolidated tax fashion, which you did mention earlier, so we probably answered your question, Peter, but perhaps we could cover Greg's question, Francis, and that's about what do you put on the return about the dividend income in your SIPP?
Well, the lovely thing is nothing. We take care of all of that for you. So it's the SIPP is not, as it were, a personal asset to which you have to declare on your self-assessment return. But obviously, areas that you do need to declare are things like member contributions, etc. And that'll be important if you're a higher rate taxpayer, because that will trigger getting your marginal rate of relief paid across to you.
Okay, and you were talking earlier in answer to Eric's question. Eric's asking that once you've claimed back the extra marginal tax relief, can that be put into the SIPP, and does it count as part of the annual allowance?
Not as such. So, I mean, effectively, the 20% basic rate tax is what can be claimed back and put into the SIPP, if I can put it in those simple terms. The marginal rate of tax, which was 40, now 50%, so further 30%, is actually given to you. Now, obviously, there's a choice there, and you could choose to make a further contribution, or to gross up your contribution a bit more, to take account of the fact that you personally will be getting some extra marginal relief. We have to be just careful about one area I will just touch on, which we'll perhaps also cover next week, which is that the Inland Revenue, however, if, for instance, you're taking tax-free cash from your pension, they're very unhappy about you recycling that into being a contribution. And actually, with the higher rates of relief now available with the 50% rate, that could be quite attractive. So you have to just watch out for that one.
Excellent. Now we've time to cover just one or two quick questions, but what I would urge is if you have questions that we haven't been able to answer tonight, or you'd like a follow-up on the questions that you have asked, do send us a question in. We'll pick that up and we'll get back to you separately outside of the webinar. So if you'd like a follow-up question, do send it in and we'll get back to you on that. But Patrick, I think we've covered your question about the dividend deducted at source. Sadly, the answer is no, you can't.
I think on that I would just add, obviously we're in straitened times, but it was interesting to see with the coalition government coming in that there was a sense that in the longer term, perhaps much longer, maybe I'm too optimistic, but we must all remember that the change that was made back in '97 has had a very significant effect on limiting the growth of pension funds.
Yes.
So it is an aspiration that maybe we can look to the coalition government to help us with, maybe in a second term, but we'll have to see. Well,
we can cross our fingers on that one. We could just take Claire's question, which I think is probably one that lots of people will be wondering, is how do they keep track of their annual and lifetime limits, which will become more important from 2011 when the limits come down?
Yeah, you could argue that's what an advisor's good for, an IFA, but it is actually down to the individual to actually track all their different pension fund entitlements. And certainly, as we'll come to in next week's session when we talk about taking benefits, then the way in which that whole process is started is by us sending out a lifetime questionnaire, which obviously needs then to summarise all of the pension provision that an individual has, in order that we can then start to test things like the lifetime allowance and the amount of tax-free cash, etc., that may be taken.
Good. And then, so as a final question, then we must let you get off to the award that hopefully is waiting for you to be presented by Shares Magazine, Francis. Ali's just asked about own limited company shares, not non-traded private companies. I think you were talking about this as a possibility earlier, and perhaps we could just cover that one very briefly for Ali.
Yeah, complex area because there are limitations on how much you can own in terms of connected party transactions, for instance, with a private company. So and also we need to actually look into what that company is actually doing. Now, if it's trading, that generally is an easier situation. If it's merely a vehicle for doing something, what we have to worry about is there a residential property tucked away in there? The amounts of that you can hold once you go over 20% holding, then there are issues in terms of things like tangible movable property within the company being assessed to tax. Now we've come across, and in fact we've involved in some quite sophisticated solutions where in fact a company that had a more higher individual holding actually worked out that if it rented all the equipment, there would be no tangible movable property tax charge. But I worry that at some point they're going to be successful and they're going to go and buy something and suddenly there'll be a tax charge that will emerge. So these things are not static. And certainly when we get into private company shares, etc., it's an area that you do need quite a lot of support on and that we need to look into the real circumstances. And as I said with my health warning earlier, it's not as simple as just buying a share on the platform. Indeed.
So I think the final advice on that one is very much to make sure you talk with your selected SIPP trustee before you actually go ahead and set your SIPP up about the sorts of things you're going to want to do with your SIPP, to make sure that it's viable, to make sure that they can handle it for you, and to make sure that the SIPP is actually going to do the things that you're going to want it to do, where it's possible to do them. And at least you'll know up front before you've left whether you're actually going to achieve the sorts of things that you think you might like to do. So Francis, thank you very much for spending time with us again this evening. We look forward to Francis and to you all joining us next week when Francis will be looking at perhaps one of the most interesting things about a SIPP, which is actually how do you take the retirement benefits. So from myself and from Francis, and on your behalf, let me wish Francis good luck in tonight's awards event. We look forward to seeing you next week. Thank you very much for joining us.
Thanks, Dave.